There's a hidden divergence on the daily pound sterling to US dollar chart that most traders are missing right now. The 4-hour flag pattern just confirmed, and with JOLTS data hitting in 3 hours, we could see a 50-pip move. I'm tracking 1.3426 as the first major support. Full breakdown with exact entries and stops is in the main video. Welcome back to Alpha Market Meridian. It's August 3rd, 2026, and I want to show you something on the daily pound sterling to US dollar chart that has completely shifted my short-term bias. We are trading at 1.3432, down 37 pips on the session, and while the headlines are screaming about safe haven dollar demand and US dollar to Japanese yen interventions, the real story is a hidden bearish divergence that most retail traders are going to completely miss. I've seen this exact divergence pattern 3 times in my career with cable. Twice it led to a violent downside continuation, and once it completely failed and we reversed 300 pips higher. Here's the tell that separates this setup from the one that failed. If you're just joining, I'm the founder of Alpha Market Meridian, and I analyze the Forex markets the way a 20-year institutional trader would, with a focus on price action, institutional positioning, and the real drivers of currency flows. We are here to cut through the noise and find high-probability setups, not to chase headlines. Before we dive into the levels, make sure to hit that subscribe button and turn on notifications so you don't miss my NFP preview later. This week, let's get into IT.my verdict for the week ahead is clear. I am bearish on pound sterling to US dollar below 1.3460, with a target toward the 1.3366 support zone and potentially the 100-day moving average at 1.3390. The invalidation level for this bearish view is a daily close above 1.3506, which would suggest we are looking at a false breakdown and a return to the multi-week consolidation range. But right now, the technicals are screaming that sellers are in control. Here's what I want you to do before we go any further. Pause this video right now and pull up your weekly chart. Tell me in the comments what you see at the 1.3200 level from last month. That's going to be critical context for the swing setup I'll share later. But for now, let me walk you through exactly why I'm positioned this way. Starting on the weekly time frame, the picture is clear. August is historically the most bearish month for pound sterling to US dollar, averaging a 0.5% loss going back to 1971. And we are not just seeing seasonal headwinds. We are trading inside a dense multi-week consolidation bracket between 1.3200 and 1.3600. That's a 400 pip range, and we are currently in the middle of it, which tells me the weekly trend is neutral but tilting bearish as we approach the August seasonal pressure point. What stands out to me on the weekly chart is not just the seasonality, but the fact that we've had 3 consecutive weekly closes below the 1.3500 psychological level. That's significant because 1.3500 was a major support zone in April and May of this year, and now it's acting as resistance. I've always said that prior support becomes resistance, but when you see the price reject that level on a weekly closing basis, it tells you that institutional money is not interested in buying cable at these levels. Moving down to the daily time frame, this is where the hidden divergence becomes visible. Look at the daily RSI. We are at 35.71, which is clearly bearish and hovering near oversold territory. But here's the divergence. Price made a lower low on August 1st at 1.3392, and RSI made a higher low compared to the July 24th low at 1.3360. That's a classic bullish divergence, right? Well, here's the twist. The hidden bearish divergence appears when you compare the July 31st high at 1.3520 with the earlier June high at 1.3616. Price made a lower high, but RSI actually made a higher high, and MACD momentum was weakening. This tells me that the bullish momentum is exhausted and we are set for a continuation lower. The daily pivot point at 1.3461 has already been breached, and we are now trading below all the key short-term moving averages. The 5-day at 1.3455, the 10-day at 1.3468, and the 20-day at 1.3480 are all sell signals. The only bullish support on the daily is the 50-day at 1.3440, which has a buy signal, but I'll tell you right now, that level is going to give way. The daily MACD is at minus 0.0010 with negative histogram growth widening below the zero signal axis, which is a classic continuation. Pattern for the bears. Now, let's zoom into the 4-hour chart because this is where the real action is happening. We have a textbook bearish continuation flag. The flagpole was the drop from 1.3580 on July 31st down to 1.3390 on August 1st. That's 190 pips. The flag itself is a tight consolidation range between 1.3390 and 1.3490, and we've just seen a breakdown below the lower trend line. The measured move target for this pattern is the full flagpole length, which would project down to roughly 1.3300. The 4-hour ADX is at 28.98, which indicates a firm, strengthening intermediate bearish trend, not a weakening one. The 4-hour CCI is at minus 202.34, which is deep inside extreme oversold territory, but I'm not reading this as a buy signal. I've seen oversold conditions persist for extended periods during strong downtrends, and this CCI reading is actually telling me that the liquidation is accelerating. This reminds me of the August 2022 squeeze, where CCI hit similar extremes and everyone jumped on the long side, only to get stopped out when the Bank of England intervened with emergency bond purchases. That was a liquidity grab that fooled most of the retail crowd. Dropping down to the 1-hour time frame, we are seeing accelerating downside momentum below immediate short-term moving average clusters. The 1-hour chart shows that we've had 3 successive lower highs since the London session opened, and the volume profile is showing strong sell-side absorption at each rally attempt. The Williams R is locked at minus 94.55, deep inside the oversold zone, which is typical of dominant intraday distribution. What I'm watching on the 1-hour is the 1.3415 level. That's the low of the 9 a.m. candle on August 2nd, and if we break that, I expect an acceleration toward 1.3366 before I go deeper into the trade setups. Let me put the fundamental catalyst front and center because this is what's going to drive price action over the next 72 hours. We have a packed economic calendar, and I want to walk you through the 3 critical events that will determine whether we test 1.3366 or reverse back toward 1.3500. First up, within the next 3 hours, we have the US JOLTS job openings report at 2 p.m. Universal Time Coordinated. The forecast is 7.5 million job openings, and if we get a hot reading above 7.7 million, that will accelerate the near-term selling pressure on cable. Why? Because a strong labor market print reduces the probability of aggressive Federal Reserve rate cuts in September, which keeps the US dollar bid. The Bank of England held rates at 3.75% at their July 30th session, so the interest rate differential narrative is completely in the dollar's favor if US data continues to surprise to the upside. Second, we have the S&P Global UK Services PMI final metrics. This is important because services make up about 80% of the UK economy, and the preliminary reading was 52.8, which was slightly below expectations. If the final reading comes in below 52.5, that will be a major blow to sterling sentiment and could trigger a break below 1.3400. I've been tracking the correlation between UK PMI prints and pound sterling to US dollar for years, and what I've noticed is that the initial market reaction tends to be muted, but the follow-through in the London session is where the real opportunity lies. Third, and most critically for the swing traders, we have the US ISM Services PMI index printing later today, followed by the US non-farm payrolls report on Friday. The ISM Services PMI is the real market mover in my view. The consensus is for a reading of 53.0, and anything above 53.5 will be a dollar positive because it signals continued resilience in the dominant service sector. But here's the nuance that most analysts miss. The employment component of the ISM is the number that matters for the NFP preview. If we see that subindex above 52.0, it suggests Friday's NFP could beat expectations, and the dollar will rally in anticipation. Speaking of NFP, that's the headline event on Friday at 12:30 Universal Time Coordinated. Current market expectations are for 185,000 new jobs added in July, with average hourly earnings rising 0.3% month over month. A print above 200,000 with earnings above 0.4% would be a dollar hawkish catalyst, and could send pound sterling to US dollar down to the 1.3250 level. Conversely, a miss below 150,000 could trigger a relief rally, but I think the upside is limited given the current technical structure. I'm positioning for a downside surprise because the leading indicators, jobless claims and ADP employment, have been trending lower. Now, let me tie this back to the price action. We have a coordinated liquidity intervention happening in US dollar to Japanese yen conducted by US and Japanese authorities, and this is creating a strong dollar bid across all major pairs. What's interesting is that the Bank of Japan's intervention is not just about US dollar to Japanese yen. It's creating a liquidity squeeze that's forcing all dollar pairs higher. The pound is caught in the crossfire because the Bank of England is dovish relative to the Federal Reserve, and that policy divergence is widening. This is the fundamental story that's going to keep sterling under pressure through the rest of this week. Now let me give you the specific trade setups I'm watching. These are exact levels and invalidation points, not vague suggestions. I'm going to present 2 scalp setups and 1 swing setup. Scalp setup: 1 short relief rally direction, short entry trigger. Wait for price to rally to 1.3455 to 1.3461 on the 1-hour chart and show bearish rejection, shooting star, bearish engulfing, or strong fade below entry. Entry price at 1.3455-1.3461, stop loss at 1.3495, 12 to 15 pips above R1. Take profit 1 at 1.3426, S1. Take profit 2 at 1.3390, 100 MA. Risk and reward ratio is 1 to 1.8 at TP1, 1 to 3.2 at TP2. Invalidation. Daily close above 1.3506. The first scalping setup is for the aggressive short-term trader. We are looking for relief rallies that stall below the structural resistance area of 1.3455. That's the 5-day moving average, or the daily pivot point at 1.3461. What I want to see is a failed breakout above the pivot, followed by a bearish rejection candle on the 1-hour or 15-minute time frame. The trigger for entry is when price prints a bearish engulfing or shooting star candle right at resistance, and then closes below the open. This is a high probability setup because we have confluence from the moving averages, and the pivot level. Stop loss placement is critical here. I'm placing my stop 12 to 15 pips above the local 1-hour lower high structural ceiling at 1.3495, which is a 1. This gives the trade room to breathe while keeping risk manageable. The first take profit target is at 1.3426, which is S1, and the second target is at 1.3390, which is the 100-day moving average. The risk reward on this trade is 1 to 1.8 at the first target and 1 to 3.2 at the second target, which is excellent for a scalp. I want to hear from you on this one. Do you like the idea of shorting the relief rally? Or would you rather wait for a breakdown below 1.3426? Drop your thoughts in the comments and let me know what your entry trigger is. I'll be monitoring the comments during the US session and I'll respond to the best ones. Scalp setup 2 breakdown retest direction is short entry trigger at price breaks below 1.3426 and retests as resistance on the 15-minute chart. Entry price at 1.3420-1.3430, stop loss at 1.3465. Above pivot. Take profit at 1.3366, S2. Risk and reward ratio is 1 to 2.1. Invalidation. 4-hour close. Above 1.3490, the second scalping setup is a breakout retest strategy. If we break below 1.3426, which is S1, I'm looking for a retest of that level as resistance. I've seen this exact pattern play out in pound sterling to US dollar numerous times, and it's one of my highest probability setups. The trigger is a break below 1.3426 on strong volume, followed by a pullback to 1.3420 to 1.3430 on low momentum. Once the price stalls and shows bearish rejection, we enter short. The stop loss for this trade is slightly above the daily pivot at 1.3465, which gives us some buffer in case the retest turns into a false breakdown. The take profit target is at 1.3366, which is S2 and a level where we have major institutional bids. The risk reward on this trade is 1 to 2.1, which means we only need to win 1 out of every 3 trades to break even, but with a 60 to 70% win rate on this pattern historically, This is a setup I'm very comfortable with. Here's a question for the community. Are you a breakout trader or a retest trader? I've always preferred the retest because it gives you a better entry and a tighter stop, but I know a lot of traders love the adrenaline of the initial breakout. Drop a breakout or retest in the comments so I know which camp you're in. Swing trade CUP trade name. Oversold bounce direction is long entry price at 1.3390 to 1.3250. Value zone. Stop loss at 1.3200. Take profit at 1.3490. Top of flag. 1.3580. Risk and reward ratio is 1 to 3 at 1.3490 and 1 to 5.2 at 1.3580. Invalidation. Weekly close. Below 1.3200 for the swing traders. I'm looking at the deeper value zone between the 100-day moving average at 1.3390 and the 200-day moving average at 1.3250. This is where I'll be accumulating long exposure, targeting a severe oversold technical bounce. The trigger for a long entry is a clear rejection candle at these levels, a bullish engulfing, a hammer, or a piercing pattern on the 4-hour or daily time frame. I'm not chasing this trade. I'm setting alerts at 1.3390 and 1.3366, and I'll wait for price confirmation before entering. The stop loss is at 1.3200, which is just below the 200-day moving average and the low of the July 24th sell-off. The first take profit target is at 1.3490, the top of the bearish flag, and the second target is at 1.3580, which was the high of the July 31st candle. The risk-reward is exceptional at 1 to 3 at the first target and 1 to 5.2 at the second target. What I love about this swing setup is the fundamental alignment. If we get a weak NFP print on Friday, the dollar could correct sharply, and this long trade could capture a significant bounce. However, if we get a hot NFP print, this long setup would be invalidated, and would be looking to add to short positions. Let me share something I've learned over the years. In 2019, I was aggressively shorting pound sterling to US dollar ahead of the US ISM Services PMI, and the print came in weaker than expected, triggering a massive short squeeze. I had my stops too tight at 1.3450, and the price blasted through, stopping me out before reversing lower 3 days later. That was a costly lesson, and it taught me that when you have a fundamental catalyst like ISM or NFP, you need to give your trades room to breathe. That's why I'm using wider stops on the swing trade and scaling into positions rather than going all in at one level. Now let me give you a 30-second pulse on risk management because this is where most traders fail. The golden rule at Alpha Market Meridian is this: never risk more than 1 to 2% of your account on any single trade. For a standard account, that means if you're trading a mini lot, your stop loss should be no more than 10 to 15 pips. For the swing trade, you would adjust your position size so that the 50 pip stop loss only represents 1% of your account. I've seen too many traders blow up their accounts by over-leveraging and refusing to take losses. The most successful traders I know, and I've been in this business for 2 decades, are the ones who cut their losses quickly and let their winners run. If you're wrong on a trade, take the loss, learn from it, and move on. The market doesn't care about your ego or your conviction, and a stop loss is not a sign of weakness. It's a sign of discipline. Always trade with a positive risk-reward ratio, and always have a plan before you enter the trade. So here's the bottom line for pound sterling to US dollar heading into this critical week. We're trading at 1.3432 with a bearish bias below 1.3460. The immediate support at 1.3426 is under threat, and a break below that opens the door to 1.3366 and potentially the 100-day moving average at 1.3390. The key resistance to watch is the 1.3455 to 1.3461 zone, and as long as we trade below that, the path of least resistance remains low. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. This is Trade Meridian Decoded channel, and as always, trade with discipline, trust your analysis, and never let emotions dictate your decisions. I'll see you in the next video.